Oil's not in a bad location, guys. So we just broke out this previous level of structure here on oil. Not the greatest way to kind of identify the next level of structure here, but we have a cipher there as well. But we're seeing a pullback here. Could be an opportunity. So this is, let's do this first. Let's measure out the cipher first and foremost to get it out the way. Let's take a look at this being our X to A, swing high to swing low, and back down. Let's see if this meets our 127 requirement. It does. So we're going to have just hit. Okay. Well, cipher just hit on oil. That was your X to A, A to B, B to C, C to D. So you're late to that party. Let's see what our volume profile tells us, right? Because we're looking for clues on where we can go to if we're likely to continue higher. And this is the perfect example of when I like to use this thing, because structure-wise, I have no idea. It is all very similar from a structure perspective. There's no clear structure level to shoot for. So, and I'm going to delete this real quick just so we can get a clear picture. So, what I want to look for is there a key price point where volume stands out? And you can see our most significant level of volume is going to be right here. So knowing me, right, and how I love structure, I wouldn't want to have targets right here. I'd prefer to adjust a little bit lower. So 78.70s can be the breakout point here, which isn't a lot of action, but could still be an opportunity. That should line up for 127 as well, if my eyes do not lie to me. Fibonacci extension, swing low to swing high and back down. Yep, 127 extension right there. Yeah, so pullback trade here on oil. You can see we're coming back to a pretty significant structure shelf that was broken. We're coming back to it. Lower time frame traders, right? And go down to your lower time frame. Price action is in that zone. Here is one where, again, we've been talking about this. This has been the theme of the week, right? Let's take a look at our stochastics, right? A few of the entry things we were talking about, right? So one, you've got the hook, right? K hook above D, also getting above the 20 line, right? That is currently happening on this candle. So we would need to see this candle complete in about 5 minutes before we can get the confirmation of that. Now, again, that could be something if you're super aggressive, boom, that's the entry reason in its own right. Or it's a qualifier for your entry reason, meaning you need that and something more traditional, or I shouldn't even say traditional, but more price action traditional, like a higher high, higher close, right? Because what do you have here with your combination, right? You've got price coming back into your zone, right? Price is going to hit a 50% retracement. Swing low to swing high, 61, 618 retracement, right? We're hovering around the 50%. So we've got price hitting our fibs. We've got strong bearish candle. Follow that up with weak bearish candle. Follow that up with another rejection candle, right? So these are all signs of what? Price pushing down, selling pressure increasing, or selling pressure decreasing. These are all signs of selling pressure decreasing, right? Follow that up with a higher high, higher close, right? A strong bullish candle, which would be a sign of buying pressure. You've got a nice little story that the market created for your entry. And then again, you can team that with, hey, my stochastics is doing the deal, right? Now, the alternative way of using that stochastic, the next one would be for that hook and run situation where, okay, you've got price action turning up a little bit. Let's say you're a trader that doesn't like to catch kind of the first part of the reversal, but you'd like for it to kind of give you a little bit more proof. That's when you look for that potential hook, you look for that run, and then you hop in after that. Now, the key thing here you got to remember, and this is important, right? You're going to see this at the end of, even more so at the end of hours. This is a very important hour. It's 8:57. So it's the close of a 5-minute candle, a 10-minute candle, a 15-minute candle, a 30-minute candle, an hourly candle, and a 4-hour candle. There's a lot of kind of positioning that happens before the end of these candles. So pay very close attention to the last few minutes before the end of a major candle. And I would say like the 4 hours, the one are going to be the most major of like kind of time-based closes. And you want to make sure you don't enter too aggressively. So following up on the conversation we had earlier in the day about FOMO, fear of missing out, or maybe, and not just in like missing a trade, but fear of missing out in the sense like, oh my gosh, right? I read the candlestick story. I like this level. I don't want to miss out on this trade. I'm just going to enter right away. It's always important that we wait for what? When we're using any type of candlestick formation or price pattern, it's always important that we wait for what? The true story will not be told until what happens? The close of the candle. So you have to keep yourself calm. You can't enter right away thinking you're going to miss it, because it's very hard. As price action spikes up here, you're seeing like, oh my gosh, we're moving. I'm getting a worse entry. I'm getting more risk, blah, 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 blah. We have to wait for that confirmation, because there is a massive difference, right? A higher high, higher close here may be an entry signal for you. Anything other than that may be a stay away signal. The worst thing you want to do is enter a trade, look back and be like, oh my gosh, I never actually got the signal to enter. And then we're in that exact same situation that we started the day off with. Where it's like, well, what do you do, right? You're in a trade that you shouldn't be in. And, well, what you should do is exit immediately. But what most traders do is kind of like, well, let's see how this plays out. And then you put yourself in a position where you're open to taking an abnormal risk. And remember, it's not the normal risk or the normal losses that get you into trouble as a trader. It is the abnormal losses. So let this thing play around. Let it wiggle and whatnot. Judge it in how it closes in about less than a minute. And then it's a simple if-then syntax, right? If it gives you a higher high, higher close, boom, you're in. If it doesn't, then you wait. And guess what we got? A non-higher high, higher close. So no trade. Again, assuming that's your entry signal. If your entry signal is just the stochastics cross, well, you got that cross. Boom. That cross, not just above K to D, but above the 20 line as well. Now you're in. So decent pullback trade here. Again, there is some room to the upside. We have that 127 confluence there. I didn't draw an AB equals CD out, but we probably have an AB equals CD pattern as well. Just my harmonic eyes. Look at that. AB equals CD, 127 right up there. Lots of confluence at that area. It's a pretty decent trading opportunity. Hope you guys enjoyed the video. If you're interested in joining us in the live room, you can do so as part of your 14-day risk-free trial membership over on the platform. That's www.tier1trading.com. Risk-free means there's no sneaky auto bill or anything like that. Simply, you're on the platform for 14 days. You get to check out and try some cool stuff. Then after that, you're booted off. That sounded harsh, but I guess it's better than doing some scammy type of auto bill where you get these bills that you never knew existed. So head over to the platform, www.tier1trading.com, check out the live rooms, download some software, interact with the community, and take some training lessons.